2, 1. Welcome to the show.
All right, it's February. Man,
It's flying by, bro.
I know.
I'm not.
It's going to be warm pretty soon.
I'm not liking it. Well, it's going to be
wait.
60 something today.
I know. I was thinking about that.
Almost jumping on the motorcycle.
I'm thinking about that.
Yeah, man. I mean, I don't know what the heck's happening though. It was like yesterday it was Christmas, and then all of a sudden it's February. I want it to slow down a little bit.
It seems like there's
I got a lot to do.
Yeah, I know.
I don't have enough time.
I know. Not enough time in the day. There's all these indicators and things. First 5 trading days and Santa Claus rally and all that. And by the time all the stuff gets wrapped up, it goes right into the next one.
Yeah. Tell us where we're at.
We have gotten above 5,000 on the S&P 500 for the first time ever.
It's crazy. We should have like a little street
Yes,
fireworks.
yeah. Woo. Round numbers tend to be a thing. There are plenty of examples in history. My dad used to tell me all about this stuff in the 70s and 80s. It worked really well. Like some of these stocks would go up to 100, and it would go to $100 and like half a cent, and then roll over and completely collapse. He would trade like the round numbers all the time. It doesn't so much work anymore, but sometimes it does. So round numbers can be pretty significant. So getting through 5,000 was a big deal. At the same time, so the S&P right now is about 4.5% ish above its all-time high from January 2022. The S and the F fund are both about 18% below their all-time high, and the I fund is about 9% below its all-time high. So the C fund, led by the Magnificent Seven, minus Tesla now, it's just, that's it. That's the only game in town.
What filled its place? It's not still the 7, though, is it? Is it 6?
Yeah, it's
the
Magnificent
Six.
It's the Magnificent, the Spectacular Six or whatever they're calling it. I don't know. I heard somebody the other day doing that, the Magnificent Seven to the Spectacular Six to the Fab Five to the Furious Four or whatever. And as they call them the generals, and as they get knocked off, the idea is if the rest of the market doesn't start getting in gear, the whole thing comes tumbling down. So we shall see. All right. So that kind of goes to this analyst divergence. So there's a ton of people that think we are in a melt-up. David Hunter has been talking about this for quite a while. He thinks he's been, for at least the past year, he's been saying we're going to like 6,000 to 7,000 on the S&P 500. He was talking about that back in October 2022 when we were down at whatever in the 3,000s. So we'll look at a couple of different people and the bulls versus the bears. Something we always talk about, divergence, right? I saw a really good definition of divergence from Tom McClellan, McClellan Oscillators, an email he just put out a little while ago. It's talking about divergence as a condition rather than a trigger. So basically, I have a chart that kind of shows the things can diverge. Price versus RSI can diverge, but it doesn't mean that that's the time that you want to buy or sell it. It's telling you a setup is happening, but it doesn't mean it's not a trigger. So you definitely need a trigger. Divergence helps you anticipate a top or a bottom, but you need a trigger before it actually happens. And then Larry Williams put out a really interesting presentation at I think it's called the Cycle Institute, but I have the link. So I'm going to pull some slides from that, and then we'll do the C-Fund chart. All right. But first, we had a really helpful subscriber comment last week, and they say, I'm a member and a retired IRS employee. On a future podcast, can you consider topics of tax tiers and tax rates? I'm not qualified to do a podcast on tax tiers and tax rates, but to his question here, at least the short piece of it, reading the comments over the last year, it's clear there's a misconception that once you exceed a certain tax threshold, that your entire taxable income is taxed at the higher tax rate. That is not true. Only the amount of taxable income over the threshold is taxed at the higher rate. So in his example, your taxable income exceeds the threshold by $10. Only the $10 is taxed at the higher rate, not the entire income. Of course, doesn't apply to phase-outs of tax credits and the ability to make retirement plan contributions. So if you're in the 20% tax bracket, anything you make over that 20% gets taxed at the higher amount, but not your whole. If you make $100,000 and you're in the 20% tax bracket, everything you make. I don't even know if I could think about this. So you pay 20%, and then if the tax bracket goes to the next one and say it's 25%, you're only paying the extra 5% on the amount that you made over that tax bracket. So,
right. Yeah, it gets chopped up. Yeah. It's levelized. Right. That's another thing that it's really hard to, like when you're having general conversations about tax implications. Yeah. This is why anytime you get into those kind of conversations, you want to have a financial planner or a tax person, a tax planner, because they have great software for this that does all those crunches all those numbers really quickly to let you know what the impact of, let's say you're getting ready to sell a big portion of your stocks, in your brokerage account. It automatically will tell you the impact if you did it versus not doing it or whatever. But that's really hard to do, like on the fly. In your brain. I don't know anybody that can.
I mean, for me, it's not, I don't make a truckload of money, so it's not a big deal, right? But if you sold a house, for example, say if you're at the top of a tax bracket, whatever it is, and you sell a house and
pushes you into the next one.
Yeah, if you had to pay capital gains on that house, whatever those capital gains were, you'd be taxed at the next tax rate because you've just capped. It would be. So, ideally sell it the next year or take some tax loss harvesting or whatever you got to do. But, but that was a really good comment. And obviously this person is watching the show and reading and seeing the comments, and it thinks people are not aware that, your whole amount doesn't get taxed at the next rate, just the amount that you go over. So appreciate the input. Absolutely. Okay. So analyst divergence. So we last week or the week before, we're talking about Tom Lee and JC Peretz. Really curious to see. JC's been a little quiet here the past few days because he was
kind of on the wrong side.
He's kind of on the wrong side right now. Yeah. So
the S&P just broke 5,000, and he was short in the S&P.
He's I don't know that he's short in the index per se, but he definitely came out. For a good week or two, this is why I'm shorting stocks.
Yeah.
And he explained why, and it's basically because the number of stocks making new highs was going down, and the number of stocks making new lows was going up, even as the price of the index was going up.
Yeah.
So the underlying pieces of everything are falling over, and he's like, the market can't keep going up if everything is going down, right?
Yeah, it's just, and it goes to show what we know, and what hopefully most of you out there know, is that no matter how smart you are, no matter how much you do this, you're never always going to be right.
Right.
It's just impossible, right? It's impossible to predict, the correct side every time. And what's funny is, like, if you go to JC's page, you follow him a lot closer than I do, but one of the things I've always kind of respected since the first time I rolled across him is, and I think it's on his about page or whatever, he really goes into a nice explanation of that, of like, hey, look, there is anybody that tells you that they're 100% right 100% of the time is flat out lying.
Absolutely.
There's just no way to be right 100% of the time, and we know that because we're not always right, and we're pretty confident in what we do, because as long as you're making your decisions off good information and your experience and your knowledge that you have, that's the best you can do.
Yeah.
And so it doesn't mean you're going to be right all the time. And this is an example where we might give him a little poking, but we also know that, like, look, this is a very smart guy who made very smart decisions many times, and just so happens this time it didn't go that way.
Yeah, but, I'm actually really curious to see his next email, because I am very sure he's just going to come out with, okay, the market changed.
Yeah, this is what happened.
It is what happened. I mean, if you look at somebody commented within the last couple of days about the S fund, because the S fund, I couldn't put up a chart. I don't think we can put up pictures in the forum comments.
You can put them in the comments. So you can't put it in the original post,
but you can put it in the comments.
I know that's frustrating for some folks, but just make the post and then refer to your comment section, and you can post video, pictures, whatever. You can put things in the comment section because it has more.
But just not the post.
Yeah.
So I didn't put the chart of the S fund up there, but it the S fund, since it peaked at the end of December, and then basically did this triangle consolidation. And yesterday, Thursday, started to break out of it, and today broke out. So if the S fund continues higher, that's small caps and mid caps rotating in. So even if the C fund started to falter here, if the S fund continued higher, the whole rally overall would keep moving. And that was the thing that JC was observing, is that the S fund, the mid caps, small caps, we're not breaking out. We're not keeping pace with the S&P 500. But this breakout changes things. So I guarantee you, I will see an email within the next day or two, probably this weekend. This change happened in the market, and therefore I closed all my shorts, and I went long on Friday afternoon. He will flip on a dime. Once things change,
he's going to respond to the market.
Yeah, he has no emotional nothing. I mean, he just this is the conditions. This is what I'm doing. And there'll be a ton of people in his Twitter and everything laughing at him and yelling at him, and he doesn't care. He wants to be on the right side of the market. So anyway, the Tom Lee, JC, Larry Williams to some extent, and most of the economists that have been around for a long time that follow the Fed, they think, well, JC and Tom Lee were expecting a pullback in the first, February, March. The other guys think that, everything's coming crashing down. And then on the bull side, Sven Hendrick, who I follow really closely, he's he's funny because he talks about it pains him. He doesn't want to be on this side of the trade. He's like, guys, everything is lining up for a melt up, like an absolute explosive melt up. And I don't want to, I don't believe it, but I'm just telling you what the tea leaves say. And it's setting up for this explosive blow off. David Hunter, we said, has been talking about it for a long time. Ed Yardeni, one of the really old school classic guys. Most of the guys in his kind of age group are thinking that we're going to roll over, but he's like, oh no, absolute blow off top is coming. And then most of the talking heads, that's like everybody on CNBC. It's all the soft landing. The Fed did this miraculous thing and got us a soft landing. So huge divergence between bulls and bears. But for our purposes, it really doesn't matter. If you're a subscriber to our site, you've been in the C fund here for a while. We've been mostly in stocks since I guess November. And it's painful because I'm looking at the indicators and just waiting for it to roll over. But until it does, it keeps going up. So that's what it is. All right, conditions versus triggers. So this is on Tom McClellan's site at mcclellanoscillator.com. So he's saying, I like to say that a divergence is a condition, not a signal. It's an important distinction, sometimes confuses people. A signal in chartist terms, and we call it a trigger, but a signal in chartist terms is something with a precise moment of indication, like seeing a price cross through a moving average or an oscillator reverse direction. A signal is therefore testable, right? If one were testing an automated trading system. So that's a signal. A condition is something that exists on a chart that does not have that precise of a timing aspect. So a condition is like being overbought or oversold, divergence versus price, and it can persist for a long time, right? Before it matters, meaning before you get the market either breaks one way or the other. So that makes it something which is not well suited to system testing, because one has to decide the moment that such a condition mattered to make that hypothetical trade. As a condition like divergence can also get resolved. So he uses this word rehabilitated. So this is what we're talking about. Divergence is when things go in opposite directions. So in this case, we have a high in price and a higher high in price, right? So I drew that line just to show we have a higher high. Relative strength put in a top on this high, but a lower high, even though price was higher here. And so that's a condition of divergence, and you're expecting the market to roll over. It's telling you, it's giving you advance warning that the momentum is decreasing even though price is increasing. Okay, it's a condition. So in this case, we got a little pullback, right? But then it turned right back up and kept going. And so what happens is you have a high, a lower high, and if you connect to that trend line, once you get past it, the condition is no longer there, right? So you have to look past it. And then we went right into a second one, right here. And ultimately that one is the one where the market rolled over. So, okay, you're like, well, it didn't roll over the first time. How would I know it rolled over the second time? You need a trigger. And so in this case, the trigger is we are below the 20-day moving average line and relative strength gets below 50. So we got a condition here, which puts us on notice. It resolved itself. We get another condition here, but now we have a trigger right there. So this is just, if a trigger that I kind of made up. Doesn't mean you should necessarily use that, but anytime price gets below that 20-day moving average line and RSI gets below 50, something's happening. And then it put us into this pretty big correction last year. So divergence isn't a thing to act on. It's a thing to watch really closely and then identify a trigger once it happens. This is one thing I wanted to point out because I thought it was pretty interesting. It's a daily chart of the S&P 500, and down here is relative strength, right? So the orange line is the moving average of the relative strength, okay? So as this purple line goes up and down, it gets smoothed out by that orange line, okay? It's the moving average of the relative strength. When that orange line gets above 70, so we talk about the purple line getting above 70 as price is overbought, right? And when it gets below 20, it's oversold. When the moving average gets above 70, things are really, really overbought. And so that's only happened 4 times since before COVID. Okay, this will be the 5th time that we're in right now. And what I mean is the moving average line gets above 70, right? When that happens, it's a significant top, because some of these pretty serious tops didn't get above, like this one, that's a pretty important top, but relative strength, moving average of the relative strength didn't get above there. This was a pretty big one. We didn't even get overbought. So where we are right now is really similar to where we were right before that COVID crash. We've been above 70, oscillating along there for quite a while, and that the moving average of the RSI is oscillating at that 70 line, and that's where we are right now. And so it doesn't mean that price can't keep going higher. It's just that the next major move is down. Like it can't go any higher, and it isn't gonna keep going forever. We can get a significant more percent, higher here potentially, but the next move is absolutely to the downside. It's just a matter of when, not if. And so when they say like blow off top, like it could be a big move down and keeps going up, and this is all part of the blow off top. Don't get confused by the timing. You have to know if you're looking at a daily chart or weekly chart and how this affects your reallocation decisions, because all you need to do is look and see that we have been overbought for quite a while, and the next significant move is to the downside. So if you're in the stock funds right now, nothing wrong with being there, because as long as we stay churning sideways, price can keep going higher. But once we start ticking down, that's the time to decide whether or not you want to lock in gains or ride it out. All right, Larry Williams. So this is a really interesting presentation he made. That's the link to YouTube. I cannot remember. It's like cyclesfoundation.org or something like that. It's really good. But here's the thing. So Larry Williams does almost all of his stuff is based on cycles. And so this is 2008. Okay, so this is what actually happened in terms of price in 2008. The red line is if you go back and take all of the 8 years, so 1908, 1918, 1928, 38, 48, you add them all up and take the average. This is the red line, right? All years ending in 8. So if you look at it and you go, okay, if I want to follow, and you know, we would call that the kind of the seasonal decennial pattern for the year ending in 8. Well, so if you use that for 2008 seasonally should have gone like that, but it went exactly opposite, right? So he went back and looked at it and said, the pattern didn't work for 2008. Is there a better way to do this? So he came up with this thing called best fit. And what he did was go back and take all the 7 years, and he has some kind of algorithm, and he takes all the 7 years and then finds the ones that how does he do this? Finds the ones that basically fit the best together and extrapolate that going forward. So that gives him the blue line. And he's calling that the best fit. So he does it for the prior year, in this case 2007, and he projects the best fit going into 2008. And so his best fit now is the blue line. And the blue line is much more like what actually happened in price. Okay, so if you followed his best fit in 2008, you would have been looking to get out of the market here at that top, which is where it rolled over in 2008. You know, you'd be looking to get back in here because that's where the bottom is and that's where it bottomed. And obviously, 2008 was a really big down year, and if you had been following the seasonal pattern in red, you'd have gotten killed. If you were following his best fit, you'd have done really well. So this is I subscribe to his annual reports, and I can't put out what he puts in those reports, but I can put out what he puts in public, and that YouTube video is public, so I pulled this off of there. I would definitely go check it out. Okay, that's 2008. So this is another thing he talks about in there. This is a metonic cycle. It's based on actually movements of the moon, but don't worry about that. That's kind of not the point. The point is they did this metonic cycle using data from 1929. Right, it included that data. 1929 was such a dramatic one-off, right? The Great Depression and all that, that when you use that data, it shifts where the forecasted line would go. So if you were using all the data including 1929, you would expect that this would have been a top, and we should be in this absolute collapse in the market right now, and that's not happening, right? So he recreated it without 1929. Okay, and so now the top is here in 25, and the market keeps going higher into that. Okay, so he's saying you got to be really careful of the data, and the big one-offs can really mess up how the whole chart works. And this one is a whole lot more, market's going up, it's coming down. It's much more consistent with what actually happened, from 2000 for the last 20 years, basically, if you don't include the data from 1929. Okay, so 2023, this was his published forecast, and this is what actually happened. And you can see it's pretty good. Nothing's exact, nothing's perfect, but it's pretty good. So where are we right now? Best fit is this green line right here. Okay, and this is kind of interesting because if you look at the year 4 on the decennial cycle, it peaks like in February. It goes down into the middle of March, goes up, comes down. You won't understand that. Basically, this down move right here, that goes with his best fit, is not what you will see if you Googled the decennial cycle year 4. This is not what the seasonality would tell you is going to happen. So I think this is really interesting, especially because the market is going higher, and so he's saying, or he's not saying, but this algorithm basically has the market going higher into March, which is where we are right now, right? So say it rolls over at the beginning of March and is going down into August. That would be kind of different than what most people are expecting. Most people were looking for a high back here in February, a correction into March, and then for the market to start moving higher into August. So it's really opposite of what most people are expecting for most of this year. Everybody's looking for a move higher after the election. But this part in here is got to be really interesting to see whether his algorithm turns out to be correct as the best fit, versus a normal year 4. So it's going to be an interesting year. One thing I wanted to just circle back on is this. If you take out that 1929 data, 20, 21, 22, 23, 24, 25. So a lot of people, basically everybody that's bullish for 2024 is extremely bearish for 2025. This is something to keep in mind. 2025 could be the thing that everybody has been worried about, the big recession and everything that everybody's been worried about since 2022. So that's on that metonic cycle. And then there's a whole bunch of different cycles, but the 18.6 year cycle is also 2025, big move to the downside. 2024 keeps moving higher. 2025, big move to the downside. So something to just keep on your radar. Okay, C-Fund chart. So we talked about the divergence and stuff, and that was a daily chart. And I just wanted to point out a couple things on this one. So this is the weekly chart that we always put up. You might say this is a divergence here. We had a high and a lower high. It's not a divergence because we had a high here, and this move down was that lower. So I wouldn't really count that. The only divergence on this chart is right here going into the top in 2022, the end of 2021. You got price moving higher and relative strength declining significantly at that top on a weekly chart, okay? So when you see divergences like that on a weekly basis, something is definitely setting up. So that's the first thing. We don't have anything like this anywhere else on the chart. There aren't any divergences like that on a weekly basis. So clearly we're not setting up for a major top right here, right? Relative strength and price are moving in the same direction. Relative strength is higher right now than at any time other than where we were right before COVID. So we are pretty extremely overbought on a weekly basis. And weekly is much more significant than daily. So it's just something to keep in mind. It doesn't mean that price can't keep going higher. It certainly can. RSI can keep going higher. But if you just look at this chart, once you get above that 70 line, that's fine. But when you break back down to it on the downside, it starts moving down. But for now, we're in good shape. We're above 5,000. Everybody's happy. Everybody thinks the market's going to keep going up forever. And as long as the market keeps going up, we will continue to be, I won't say we'll continue to be in the C fund because I'm thinking about the S fund honestly right now. But we shall see. Yeah. All right. And so if you guys like what we're doing, if you want some more in-depth analysis kind of day-to-day, check us out at growmytsp.com. Questions?
As always, if you have any questions, please put them in the comment section wherever you find this video. If there's no comment section, you can shoot us an email at support@growmytsp.com, and the support folks will get it over to us. Hope you like the videos. If you do, please share them with your friends. Hope you guys are having a great time. It's a good time of the year, I think, getting into the getting past all the New Year's resolutions and actually seeing what we're really going to do.
I made a few of those.
I've already broken all of them. I'll see you guys later.
Out here.